I'm going to go over a little bit of how to present a 32-year-old male different life insurance strategies. Okay, this could be used for 35-year-old, a 40-year-old, a 50-year-old, whatever. There's a lot of different people, but this is works really well for your healthy and middle class to moderately wealthy people, because if they're all jacked up, the premiums can be so high that it throws some of this out of whack. But what we're going to look at is the satisfying the death benefit and what people end up with when the policies are over or run out, or don't run out. Some of them don't run out, but some of them will go on and on and on forever. And that's what we're going to look at. Some of you already know some of this, but I'm going to try to use the numbers to make it make sense. So if I'm sitting down with myself and I'm saying, self, you need $500,000 worth of death benefit. One of the most common things that I sold early on life insurance to people in my kind of demo would have been just 20-year terms. It's real common to buy.
So are they
cheap. Dave Ramsey says buy term and
invest the rest.
Okay. Now what do people do?
Buy term.
And they don't invest the rest. They spend the rest. Okay. So Dave Ramsey's advice, people like to follow the easy advice, but not the hard advice. Okay. So this strategy wouldn't be something that Dave Ramsey would subscribe to, because he would probably say buy term and then voluntarily invest heavily in mutual funds for the next 40 years. I can tell you, as someone who dabbles a little bit in the index mutual funds, a lot of times I like to cash my earnings out and spend them on stuff. This will be a way where you can't as easily do that. You're turning your savings into a bill. Okay? On a 20-year term policy for me, $500,000, the premium on a standard term is $32.12 a month. That cheap. You probably get it even cheaper than that. For the purposes of this, I did use a surety for the term quotes, because they have a return of premiums rider, so that made it easy to quote with the ROP. But you could probably get it even cheaper than that, for 500K. 500K, about $32.12 a month, right? The return of premiums rider option, $78.30 a month. Okay, so it's more, same death benefit, it's more, because they want you to pay in more, because you're getting some sort of guarantee at the end. On the last one here, I put IUL, Index Universal Life, plus term, because the way that it makes sense to do this is to structure your IUL with a lower death benefit and a higher cash infusion on the premium. So what I did, now this is, we can run this way differently, but this is going to kind of look crazy, but I did a $500 a month premium into my IUL with a $45 a month 30, I'm sorry, and then I went back and say I did my, well actually I did run it as a 30-year term. 30-year term over here instead of a 20-year, 250K. So this death benefit is 250K, and the 30-year term is 250K death benefit, and it's $45 a month. So what's funny is when you're comparing these, most of us look at it and be like, how am I going to go from $32 to getting somebody to pay $545 a month? Well, you have to transition the sale to not really be completely about life insurance. And so when you break down the next part, you're saying at the end of this 20-year term, over here, you have paid in.
Okay, I do have.
Somebody get a calculator out so I don't have to calculate it all.
What is it?
3212
665
times 12 times 20.
665
$77.08.
So negative $7,708.
Yeah, and 80 cents.
And 80 cents. Okay? At the end of 20 years, you're negative 7,708. We negative 770880, right? So who thinks taking 20 years worth of premium, throw it into something, and at the end of it having negative $7,708 and walking away with nothing is a good value? Obviously, there's a benefit there. I have a 20-year term. If something happens within that period, it covers my interest there, right? But from a long-term perspective, there's not a huge win there. Over here on the return of premiums rider, if they keep it the entire 20 years, then what's 7830 times 12 times 20?
I got the difference between the two is 11,083.20.
18,792.
So you're going to pay in 18,000 what?
$792.
792. At the end of it, you're going to get back your 18,792. So you're zero at the end.
So it does give you a 100% return.
If you keep it the entire 20 years, most of them do.
But if you cancel, I don't give you nothing, right?
Well, it depends. It's on a schedule, and so normally, like on a 20-year one, the first 10 years they probably won't give you anything if you canceled it. But if you canceled it like 15 years in, they might give you 50% of it.
Okay.
50% of what you paid in up to that
Right.
point. So it's on a schedule. But if you keep it the entire 20, so you're going to sell the ROP, you're really going to sell to somebody, you need to keep it the entire 20 so you can get your premiums back, and then you weren't out anything. Now it costs more that time, and also the companies make a lot of money on people canceling it. Somebody comes along and they look at somebody's policy and they say, here's a 7830, I can get you that same benefit for $60 a month, and they rewrite it 10 years in, and the guy forgot he even had a return of premiums rider on it. So over here, this one that we ran, I actually got with Pete, and he helped me run one of these. This one's National NLG, National Life Group, and it has a lifetime income benefit rider on it. So 20 years into this, I'd be what, 62? So just for the purposes of this one, because they have it broken down easy, at 69, my lifetime income benefit rider here,
That's dope.
guaranteed. So now that's lifetime. So if you live to be 90 years old, that'd end up paying out like $694,000, and you would quit paying the premiums in at age 60. And if you quit paying the premiums in at age 60, you would have paid in $180,000 in premiums. Now, where they're going to make their money is if you die in 5 years, they don't have to pay you anymore. That's how a lifetime income benefit rider works. The cash value on it would be about $384,000. There would still be a death benefit on it, but the death benefit would begin decreasing as you use the lifetime income benefit rider. It'd be like an annuity. Like it's creating itself into an annuity with a high guarantee. So I mean, it has a high potential LIBR, lifetime income benefit rider payout, where it could be up to it could be up to $1 million if you live to be 100 years old, coming out of $180,000 worth of premiums in it. It's also not taxable income, so you're not paying taxes on it. And then that $384,000 surrender value at 60, you could just surrender the thing and take $384,000 out, and you'd only pay $180,000. So I guess the premise is there are ways, if somebody's really getting into life insurance and you run across somebody that is making six figures, or they're looking at planning on retirement, or you can turn it into a $20 a month term life sale that's not even really worth your time, and get it over into something that's better for you, better for them. Because most of these people, when you sell them these cheap terms, they do not save the difference. So even the return of premium rider would be a better deal for a lot of these people if they keep it. So you have to tell them what they're getting, because a lot of them, it's the first sign of like, oh, my income dipped a little bit, they're going to cancel it 10 years in, and then they just blew through a bunch of extra money. But I wouldn't. And also, if you get into these guys that are like really young, they're like, I'm 30, I want a 20-year term, I need $500,000. Just say, why don't we do $1 million? It's $500,000. Like, so many people do that. I need $500,000. I don't know. I have $2.8 million, and now I need more than that. But like, if you have a wife and kids, You need more than 500,000. You do. I mean, when you're thinking about it and you're thinking about like needs analysis, like okay, Sid has 3 sons. Financially, what is Sid worth to those 3 boys in their lifetime?
Up to 18.
About $1 billion.
750,000.
Annual income times 10.
250,000 per child till they.
I mean, to me, it's like you can't really put a fixed number on it. He's worth a shitload. Because if they lose him, then somebody else is going to be having to flip the bill for stuff, and he doesn't know how much he's going to. You also have to think about your earning potential. Like, I mean, Sid might, end up making $500,000 a year one day. So then so when you're buying the benefit, buy for what you think you want to leave your kids behind if you do that. Especially if these young guys, it's not that expensive to get a really good policy or a really high benefit. Even if you're going to do just the term, and they want the most death benefit possible until their kids are grown, jack that death benefit up. So there's plenty of reasons to make the premium higher that are actually in the best interest of the client and their beneficiaries, that aren't just, I'm trying to make the premium higher so I make a better commission. So I know if I had a term policy I sell to, when I first got out, I had a different mindset about what benefit was necessary. So I had a friend that was a doctor, and he had like 7 kids, and he took an $800,000 20-year term policy. And he was a doctor with 7 kids and a wife. One of the kids with special needs, and I was like, now, like looking back now, I'm like, 800,000, you're leaving that wife with 7 kids to take care of? Yeah, and the oldest one was 17 at the time, going into college. Another one was about to be driving, and one of them with special needs, going to be with her forever. I'm like, dude, you're a doctor. You need $3 or $4 million policy, really. I mean, you don't need to be. She don't need to be worried about like how she's like. Cause okay, say that comes in and it pays all their mortgage off. It pays everything off. How long is the rest of that gonna replace your income for? Not gonna replace it that long. So I just think differently about those death benefits when you do get somebody that, and a lot of times your term is going to be some of your warm market, like friends or family or something. You want them to have more coverage than they need, right?